theoretically, if it followed a similar path, you could put in about 100,000 today, wait about 5 years, and you could leverage it with about 10% of debt. Now, the thing with debt that you have to understand is that we're in a debt-based system, so we need to use debt in order to get wealthy. The problem is debt is very dangerous to use. You wouldn't let your little kid play with fire because they could burn your house down. But we use fire to heat our house or cook our food, but it could also burn the house down. So you don't let little kids play with it. But hopefully as we become adults, we're smart enough and responsible enough to use that debt or that fire.
Today we delve into the intricate mechanics of wealth accumulation and preservation within the realm of finance. Mark Moss, a prominent figure in the Bitcoin space, enlightens us on the strategic maneuvers and considerations involved in navigating the current financial landscape. From dissecting the nuances of taxes to exploring the role of debt as a double-edged sword, Mark provides invaluable insights into the game of money and how Bitcoin fits into the equation. Before we get on with the video, we'd like to introduce our sponsors, Stampseed. Don't forget to follow the link in our description below for 15% off your stamping kit. Furthermore, 77% of our viewers on this channel are not yet subscribed. If you are enjoying this content and want to support our efforts, please hit that subscribe button and help our videos find more people. Without further ado, here is Mark Moss on the What Bitcoin Did podcast.
The other mechanism in the game is taxes. So that takes a lot of our wealth. And then we have the players in the game, as I said, Wall Street, the government. We also have bankers. So first of all, we're all Bitcoiners. We're trying to change the system. We don't want this inflationary system. We don't want fiat currency. We don't want the banking system as we have, but it is what we have today. That's the game that we're in. So I think for us, we're simultaneously trying to build the new game, but we're stuck playing the game that we're in as well. So if you think about it, like I remember as a kid growing up, my parents were like, oh, I wish, I don't have a money tree in the backyard. What do you think? I have a money tree. Well, we do all have a money tree. Every one of us does, because we're in a debt-based monetary system. And that means that money is created through debt. Right? We talk about the Federal Reserve, let the printers go burr. Like that's not how it works, right? So money is created through debt issuance. And so anyone can, well, not anyone, but if you have built up enough skill set and mental capacity and relationships, I can go to the bank right now and get $1 million to buy a business or go buy $1 million apartment complex. They can just give me that money through debt issuance. And so then we have to understand that in order to play this game of money, if the goal is to get assets, then I need to use the mechanism of the game, which would include debt. The other reason why we want to understand that debt is because the biggest loss that we have, besides inflation or bigger than inflation, is taxes. And by using debt, we can get around taxes. So those are sort of like the mechanisms of the game. But I think you wanted to talk specifically about the long-term vision of Bitcoin and the entry places and the exit places. It was like selling Bitcoin. So that you think about selling it for dollars. So you talked about selling it to get a car. We were talking before we started recording. I sold it to get a house. I didn't sell it to get a house. I traded it for a house. And that's a big difference. And the reason why is because we don't want money. We want the things that money gets us. Money is a means to an end. So we're trying to get to the end, right? And so like I'll exchange my Bitcoin for other things maybe at some point, right? We have both done that, but I'm not selling it for dollars. And I think that's the big difference. At what price will you sell? I won't. Maybe I'll exchange them for other things in the future. But right now I'm going to continue earning in dollars. And I'm going to continue to use those dollars. I think of the one thing that I use to reframe this just for myself, and it's semantics, but I think about earning my wealth through my businesses and then deploying those into assets. But I think about those assets as savings, not investing. So I save in Bitcoin and I save in real estate. And the reason why I think about it like that is because I think about it long term, like the infinite game. Like I'm building this new house in Mexico right on the beach right now. And like, I want my grandkids to grow up in that house long after I'm gone. And so that's where my wealth is going to be saved. And that hopefully will go down through multiple generations of me. And so it's not an investment. And since I bought it, that area is blowing up and I'm not super happy about it because I kind of want to be out sort of on my own a little bit. And everyone out there is like, but Mark, look how much your property value has gone up. I'm like, I don't care. because my goal was never to sell it in the first place. So anyway, I think about it as savings, and that's sort of that long-term game, if you will, right? So if we're doing that, then we talk about like increasing your purchasing power, like a store of value. But I would just think about it as like long-term, lock it up in savings. Then it leads us to the next piece. So if we're using Bitcoin as a way to store wealth in this game, in this game of money, if you will, then what happens if we do want to get the house, or we do want to get the Lambo, or take a vacation, or whatever it is, right? So in the game of money, one of the biggest ways we lose our wealth as we're trying to build it, the game has the mechanism of inflation and taxes that take our wealth, taxes. Now, depends on where you're at in the world, or what state you're at in the United States, and how much income you make. But in California, as a tier income earner, half of your wealth goes to tax, half. So let's say that I do buy the Bitcoin for $100,000 and it goes to $200,000. Right now, it's been averaging a 200% compounded annual growth rate. Michael Saylor's leading the speculative attack, leading the classic textbook example of how to use a weak currency to buy an appreciating currency. He's borrowing at 0.6 and buying a 200% compounded growth rate asset. So obviously, I believe that goes down. Most people agree that that will go down over time. As the asset gets bigger, the volatility will go down and the asset appreciation will go down as well. And maybe over a 20-year period, that drops to 30%. So over this long period, I have this calculator that I've built that I have all this worked out. And so let's say that it goes down to 30%. Well, what happens is if I have this Bitcoin that I want to now get the Lambo, get the beach house, or whatever that you want, I have two options, right? So I bought it at 100,000, it's worth 200,000 now. If I want the $50,000 to go buy whatever it is, I can sell the Bitcoin, the $200,000 worth of Bitcoin, pay half of it to the government. So capital gains, you have long-term and short-term. So if you hold it for less than a year, it's short-term capital gains, which is taxed the same as ordinary. So this is just framework to think about things, right? And that's really the key piece, even what we went off on a tangent on about the favors. These are just different ways, different mental models I use to like kind of look at the world and try to understand things from a different angle. None of these are like conclusive, this is the only way you can think about the world, right? They're just like sort of models and framework. So back to the tax situation. Yes, of course, as I already said, depending on what country you're in, depending on what tax bracket you're in, what state you're in, these numbers change. So I sell the asset and I pay the tax and I have what's left over. I think it's in all of our best interest to get that number as low as we possibly can legally. And so I can pay those tax dollars and then I have whatever I have left over and I can go buy whatever I need. The problem is I no longer have the Bitcoin for the capital appreciation. So option 2 is I can borrow against that Bitcoin, which now is debt against the Bitcoin, because remember the mechanism in the game is debt. I'm using debt, which means I owe no tax on the Bitcoin now. I can buy whatever the thing is that I wanted to buy, and I still have the Bitcoin for the continued capital appreciation on that.
Today's video is sponsored by Stampseed. Don't store your Bitcoin in cold storage without stamping your seed phrase on an indestructible titanium plate. Stampseed is fireproof, rust-proof, impact-proof, and easy to hide. It has no loose parts and will give you ultimate peace of mind that your Bitcoin is safe and sound for the long term. Click the link in the description below for 15% off your stamping kit. Welcome to Bit Intelligence. We are committed to bringing you top-notch Bitcoin-only content. Subscribe to our channel and hit that bell icon. Okay, back to the video.
I have a whole book that I've written that I haven't published. It'll probably maybe come out by the time this interview comes out. And I have a calculator link. But basically, this is based off of assumptions of, one, where Bitcoin has come. So that's the history, but more assumptions as to where it will go in the future. And so we can talk about where we think Bitcoin goes in the future. Is it $1 million by 2030? Is it $1 billion by 2048? Like some would say. And as I said, the way that I've sort of projected it was probably dropping down to about a 30% compounded annual growth rate. We also know that Bitcoin has sort of had this pattern, like a 4-year cycle pattern. So I kind of accounted for appreciation as well as depreciation in that fourth year. And there's no guarantees in life, but theoretically, if it followed a similar path, you could put in about 100,000 today, wait about 5 years, and you could leverage it with about 10% of debt. Now, the thing with debt that you have to understand is that we're in a debt-based system, so we need to use debt in order to get wealthy. The problem is debt is very dangerous to use. You wouldn't let your little kid play with fire because they could burn your house down. But we use fire to heat our house or cook our food, but it could also burn the house down. So you don't let little kids play with it. But hopefully as we become adults, we're smart enough and responsible enough to use that debt or that fire. Debt is like the same thing. And so the Dave Ramseys of the world are out there like, never use debt, don't use debt. A lot of Bitcoiners are like, don't use debt, don't use debt. And that's right for about 90% of the people because they're just not smart enough to know how to use it. Where does it go wrong is that, again, the leverage could burn your house down, right? So where it goes wrong is when you can't afford to carry the debt. If I borrow, let's take that out of the equation. This is what happened to me in 2008. I got wiped out. I had a whole bunch of real estate, and when the market crashed, I couldn't afford the monthly payments to carry it, and so I had to short sell some and let some go back to the bank. Right? I couldn't afford to. So the same thing, right? So if I borrow against the Bitcoin and I, for whatever reason, can't afford to carry that, or and to the point you're talking about, it goes down and I can't cover a margin call, right? So that would be the risk. So let's talk about that. Because what we always want to do is we always want to plan for that risk, right? I like to think like, what's the worst that can happen? And am I okay with that happening? That's sort of my bottom line risk management. So for example, for using round numbers, and again, this depends on where you live in tax bracket, but let's just say for easy numbers that I sell $150,000 with Bitcoin, I have to pay 50% tax, and I end up with $70,000, $75,000. Okay. So I have 75 grand and I no longer have the Bitcoin. Option 2, I keep the Bitcoin and I have $75,000 cash because I have debt against it. Now let's say that I lose the Bitcoin. It drops by 80%. I get margin called. I can't cover it and I can't cover the payments. And so they liquidate me. Am I worse off than I would have been if I would have sold it in the first place? Did I give up some of my Bitcoin to get the thing that I really wanted? I did. But I still have plenty of Bitcoin and I still have lots of other assets. And what I really wanted, you said earlier, the money is a means to an end. What we really want is time, freedom, for me, experiences. And what I got in exchange was what I ultimately wanted money for in the first place. So people are going to buy Bitcoin because one day they can get what they want.
As we conclude this conversation between Mark Moss and Peter McCormack on the What Bitcoin Did podcast, Mark shares a fresh perspective on wealth, debt, and the long-term vision of Bitcoin. Mark's insights challenge conventional wisdom, urging us to rethink our approach to financial strategy. Whether it's leveraging debt to preserve assets or reframing our understanding of taxation, Mark reminds us that in the game of money, strategic thinking is paramount. So as we continue our journey through the ever-evolving landscape of finance, remember the lessons you learned today as you strive for financial resilience in an uncertain world. Stay tuned for more enlightening discussions, and remember to subscribe for the latest recaps, insights, and films about all things Bitcoin. If you want to watch another one of our podcast recaps, try this one here. We'll see you next time.